Okay, let's jump right in. Netflix, a $1 trillion market cap by 2030. That's a huge number.
Yeah,
You're probably thinking, like we were, how on earth do they plan to get there? What does that even mean?
it's a fascinating goal, definitely. And that's what we're digging into today. We've been looking at this analysis from the Motley Fool. It basically outlines the roadmap Netflix management sees, pulling from what they told the Wall Street Journal.
Right. So our mission here for everyone listening is to unpack those strategies. What are the key things Netflix thinks will drive what? Potentially 139% value increase in just 5 years. We want to give you that clear view.
Exactly. So the headline figure,
Yeah.
$1 trillion market cap, target date 2030. And like you said, that's about a 139% jump from where the article pegged them in April 2025. The scale of it is, well, it's striking.
And you have to remember the context, don't you? Netflix dominated streaming, then hit that rough patch in 2022 with subscriber losses. Some folks were definitely questioning their future back then, but they've clearly bounced back strong.
Oh, absolutely. And the Motley Fool piece really highlights the key moves that powered that comeback. Things listeners should really note are getting tougher on password sharing, launching that cheaper ad-supported plan,
And moving into live sports, yeah.
and moving into live sports. Exactly. Those weren't small changes. They were pretty major strategic shifts.
Okay, so they have this momentum now. How does that translate into aiming for $1 trillion? It must come down to some hard financial targets. What are the key numbers we should be watching?
Yeah, the core plan really is this. Double annual revenue to around $80 billion, and maybe even more importantly, triple their operating income to $30 billion, all by 2030. That profit jump, that's really what they see driving the valuation up.
Okay, let's break down that revenue growth first. Where do they see all those extra billions coming from? Subscribers are still part of it, I assume.
They are, yes, but maybe not the main engine for that huge leap. Their goal is about 410 million subscribers by the end of 2030. Now, that's still a lot of people, obviously, but the growth rate works out to about 5% compounded annually, or maybe 18 million new subs each year.
Which is interesting because, as the analysis notes, they used to add way more, right? Like 25, even 30 million a year sometimes.
Exactly. That suggests, they're seeing the limits in some areas. The article points to markets like North America getting pretty saturated. They're already in something like 75% of broadband homes there. So for listeners, the takeaway is that explosive subscriber growth in those places is probably over.
Okay, so if pure subscriber growth is slowing down a bit, that puts more pressure on other revenue streams, and the big one that jumps out is advertising, obviously.
Absolutely. Their ad revenue plans are, well, incredibly ambitious. The Motley Fool estimates maybe $2 billion from ads in 2025, but the goal for 2030, a huge $9 billion.
$9 billion! Wow.
That number alone tells you how central ads are becoming to their strategy.
So what's the thinking behind that confidence? How do they get from 2 to 9 billion?
Well, the logic is pretty straightforward, actually. Users on the ad plan, especially if they watch a lot, can end up bringing in more total revenue per person than someone just paying the subscription fee because of the ad money on top.
Right, more viewing equals more ad slots.
Exactly. And it's fascinating. Netflix is even changing how they talk about their success. They're planning fewer updates on subscriber numbers because ad revenues is becoming such a key metric for investors now.
And it seems like consumers are buying into it. That statistic was interesting. 43% of new signups in February took the ad plan.
Yeah, 43%. That tells you something, doesn't it?
It really does.
Yeah.
It suggests that lower price point, maybe combined with people just getting more used to ads online, is working for a lot of new customers.
It's definitely a validation of that whole ad-supported strategy.
So, okay, more subscribers overall, plus more ad money per user from a big chunk of them. But they're also expanding the type of content too, right? Live sports is the big one mentioned.
Yes, that's a really significant shift for them. Historically, they stayed away from live sports, but the article stresses it's now a key growth area they plan to push hard on.
Which makes sense. Opens up new audiences, different ad opportunities tied to specific events.
Precisely. It's another lever to pull for growth.
Okay, so the revenue plan seems clear. Steady sub growth, a huge ad push, plus new content like sports. But what about tripling operating income? That sounds like it needs more than just revenue growth. It needs efficiency gains, too.
It does. And a big part of that is expected to come from scaling the ad business itself. As more people use the ad tier, and as they get better at delivering ads, the cost per ad should, in theory, go down. The article even mentions they plan to bring their ad tech in-house, moving away from Microsoft's system eventually.
Ah, okay. Taking control of the tech usually means better margins down the line, doesn't it?
Potentially, yes. It signals they're really serious about making the ad business highly profitable long term.
What about the other side of the coin, content costs? Can they really grow subs that much without spending proportionally more on shows and movies?
Well, the article suggests maybe they can find some efficiencies there,
Mm-hmm.
especially as they branch out. Live sports rights cost a lot up front, sure, but maybe they attract a big audience without needing the constant stream of new original series investment in quite the same way.
Diversifying the content mix could potentially manage costs better.
It's about finding that balance, maximizing reach and engagement without letting content spending spiral completely out of control.
Now, this all sounds plausible, I guess, but the article does flag some challenges. That PE ratio, for instance, 49. That feels high. It suggests investors already expect a lot of this growth, right?
It absolutely does. A PE of 49 means the market has priced in significant future success. So to actually hit that trillion-dollar mark, they really need to deliver on these ambitious numbers. There's not much room for error.
Yeah, the pressure's definitely on.
But on the other hand, the analysis brings up an interesting point about resilience,
Aye.
especially with all the talk about trade wars and economic uncertainty.
How so?
Well, streaming is digital. It's not like shipping physical goods that get hit with tariffs. So during times of trade friction or economic slowdowns, a company like Netflix might look relatively stable compared to others.
And there's also the argument that, if money gets tight for people, a Netflix subscription is cheaper entertainment than going out to the movies or concerts, right?
Yes.
People might cut back elsewhere but keep Netflix.
Exactly. It could be seen as a good value proposition in a recession. People might even watch more. The article even noted, sort of anecdotally, that Netflix stock was actually up between early April and mid-April 2025, right after President Trump announced those global tariffs.
A little sign of market confidence, perhaps.
Could be an early indicator, maybe, of how investors see its resilience.
So summing it all up, even if that trillion-dollar number is a, let's say, stretch goal, the overall takeaway from the Motley Fool piece seems pretty positive on Netflix's prospects.
Yeah, that's the general conclusion. Even if they don't quite hit $1 trillion on the dot by 2030, the underlying business looks strong, the growth drivers are there, and it's still considered a solid investment likely to beat the market average.
Okay, so to recap for everyone listening, Netflix has this incredibly bold vision, $1 trillion by 2030. It hinges on pulling off significant growth, especially in advertising, adding subscribers steadily, becoming more efficient, and potentially benefiting from being a bit insulated from certain economic shocks.
That's a good summary. They're betting big on this blended model subscriptions plus a major ad business and expanding into new content territory like sports.
Right. So the question for you, the listener, as you think about all this is, what do you reckon are the biggest hurdles for Netflix? Where might they stumble on this path? And flipping that, where are their biggest, most promising opportunities to actually make this happen?
Yeah, chew on that. And maybe think bigger picture, too. If Netflix does pull this off, if they become a trillion-dollar company, how does that change the whole entertainment game? What does it mean to be a media giant then? And what other shifts might we see as everyone else tries to keep up?